Good morning. Welcome to the last webinar of the year, and what an end. I can't believe what an amazing month November was. The best November since 1928. Dow reaching new highs, breaking above 30,000 for the first time. It almost feels like 2020 is trying to redeem itself at the last minute. I'm not sure it'll quite get there, but hopefully it's setting ourselves up for a good 2021, and we'll review our positioning at the end of the presentation, including top picks. But let's start off with the usual, our surveys. As you can see here, the funds continue to do well over the various timeframes, from 1 year out to 10 years, and across the various risk profiles, from the low risk funds up to the high risk funds. Number one across almost every category and time frame. Looking within the multi-manager survey for the Signature 70 fund, you can see similarly number one across 1, 3, 5, 7, and 10 years, and well ahead across the 1 year period relative to other funds. Similarly, looking against the underlying single managers, looking very good over 7 and 10 years in the long term, 3 years number 2, and 1 year number 3. So the fund's still holding up and performing well in this volatile, low growth environment that we really do believe is going to be with us for quite some time. Hopefully 2021 will be a good cyclical bounce. If you look at Japan as a roadmap, you can see their stock market has doubled, even over the last 20 years, it's flat. So when there are good opportunities, we need to take advantage of them, and when we're running out of opportunities, we need to move out of them. So being tactical remains key. But of course, it's all about the virus and the vaccine now. So our friend Fauci, very happy, declaring that the cavalry is coming. Fauci was elated with the very good vaccine news, and it certainly did drive up markets this month. One of the main reasons that markets are up over 10% this month. So what was the headlines? Well, it was really about the 3 vaccines from Pfizer, Moderna, and Oxford, all of which are looking phenomenally good compared to the success ratio that vaccines normally have. So Pfizer was out first with its news, 95% effective. That's really an incredible number. They expect to start deliveries on the 15th of December and expect to provide up to 1.3 billion vaccines next year. If you look across the chart on the right, you can see there that their pricing target per dose, $20. It's relatively expensive, but in the middle of the pack. Next out with their phase 3 trials was Moderna. Their vaccine was 94.5% effective. And what's exciting about their vaccine is that it has fewer logistical challenges, whereas the Pfizer vaccine can only be in a normal refrigerator for 5 days. The Moderna one can be in a normal refrigerator freezer for up to 30 days. Beyond that, they have to be stored in incredibly low temperatures, to the point where you're spending millions and millions on fridges. And I believe the only fridge currently in the Western Cape capable of getting down to those temperatures is at UCT. So certainly a very big logistical challenge for Pfizer, not as much for Moderna. And what's most exciting about the third vaccine, Oxford Astra Zeneca, is that it can stay at normal refrigeration temperatures. So far less logistical issues. And even more exciting, if you again look to the chart on the right, you can see there Moderna being the most expensive at $37, whereas the Oxford AstraZeneca vaccine is coming in at $4, a tenth of the price. So that's particularly exciting for emerging markets where they're going to deliver it at cost. It's very exciting. Unfortunately, although the vaccine is looking effective, 70% effective after 1 shot and up to 90% effective after a second shot, further testing is required for their phase 3 trials. So we haven't got an as clear picture in the efficacy of the Oxford vaccine relative to the other 2. But overall, incredibly exciting news. 3 very promising outlooks. The UK has already given regulatory clearance for the Pfizer vaccine, so that should start in the next week or 2 being administered. So we really have got to the point. We kept saying it was going to be towards the end of the year, and amazingly so, here we are, a few weeks left until Christmas, and the vaccine is being rolled out. It'll take time, but the markets now can clearly start to look through and the huge volatility and risk that has been associated with the vaccine. Yes, there will still be mild lockdowns like we're looking at locally in PE and possibly in the Western Cape, but and as we're seeing throughout the US and Europe. But the availability of the vaccine means that worst case scenarios are now off the table, that we can very soon start to deliver to people working in hospitals, to the frontline staff, as well as the high risk and people above the age of 60, who the World Health Organization have suggested should start receiving the vaccine first. And yeah, that means that this is one less volatility point for us to worry about in 2021. Unfortunately, it will take months to roll out, and it has changed the way that economies are working. So, you know, the new normal, or a move to the new normal, is something that still has to be considered and managed. But at least we're getting to the point where the completely overblown valuations for the COVID losers are starting to recover. And I'll show you a great graph on that towards the end of the presentation. So the other reason that the markets had such a strong November was the US elections. Here's a great quote by Biden saying that that's the decision of the American people. So finally, after many, many weeks of toing and froing and umming and ahhing and trying to work out exactly whether Biden had won or whether Trump was going to pull something out of the bag, on the 23rd of November, it was declared that Biden was officially designated the next US president. And what is amazing is, despite that long time period and all the volatility that occurred within it, he actually won by 6 million votes. 6 million. That's a very nice margin. And it looks like 306 electoral votes to 232 electoral votes. So despite all the concerns, a nice clean victory by Biden. And certainly the markets rallied very nicely, mostly because a Biden victory means that the US will have a much more collaborative foreign policy. Yes, they will still be hard on China. Yes, they will still be worried about currency manipulation, but anything that happens will be well signposted and will happen in a collaborative approach with other members of the United Nations, and markets will be able to digest that movement cleanly. There's going to be a lot less concern about a tweet at 3 a.m. in the morning that derails global growth. Yes, there certainly will be risks next year, but tweeting at 3 a.m. is not going to be one of them, fortunately. So within the US, very nice to have Biden officially designated. The unknown at the moment is still what happens to the Senate. So there are two runoff elections in Georgia on the 5th of January. If the Democrats win both, that would result in an evenly split Senate, which means that Biden, as the president, would have the final say, and we would actually end up with the blue wave that some were talking about just before the election week. And that would facilitate further fiscal stimulus, but also tax increases and antitrust regulations. So the market might not be as excited about that as they were in the past. Georgia historically has been a Republican state, and the Republicans only need to win one, if not both, of those races to maintain Georgia. And currently, odds checker is giving them an 80% chance of winning those, either one or both, and maintaining that, which will then come to the current situation, which is a divided US Congress. And that is really good for markets. We spoke about last month. It's a purple situation of a red Senate and a blue House. And it just means gridlock, which means the government's not going to be able to break things. Ironic, but that is how markets view it. The less they can break, the less uncertainty there is. So assuming a divided US Congress, Trump's business policies will stay intact. Biden won't be able to raise taxes significantly or increase regulations in any meaningful way. So we really are sitting in a really nice end to 2020 with 3 vaccines that are very promising, Biden in the US, and a divided US Congress, which is setting up markets well for 2021. The other bright news point is emerging markets and China. China announced its 14th 5-year plan, and at the BRICS conference, the president said, "You can count on China to keep its promises." Something not everyone will believe. Certainly, there are many doubters when it comes to the data that comes out of China and the truth behind some of that data, mostly because some of the numbers come out a day after GDP comes out, the day after quarter end. Other countries take a month. Maybe it's just efficiency. Maybe it's not. But what was quite interesting is that at the BRICS conference, China has now agreed to focus on climate change, which is very important. And China makes up 29% of global emissions, and they're a massive polluter. And at the BRICS conference, they said that they will target peak carbon dioxide emissions by 2030 and carbon neutrality by 2060. 40 years away, it's quite a lot of time, and we won't know if they do keep their promise or not for a very long time. So it's quite a safe promise to make. But it is interesting that China is now moving in line with the concern for global climate. But as I said, emerging markets and China looking strong. The chart here on the right shows the fiscal thrust or fiscal drag, basically the fiscal support the governments are putting in place. The dotted line is global, and you can see here in the middle that was 2009 from the great financial crisis, and now 2020 we're seeing a much higher, nearly double the fiscal stimulus that was used in the great financial crisis of 2009, and further the highest global fiscal stimulus in the last 2 decades. So that's you can see here over the last decade we had negative fiscal stimulus or fiscal drag through most of the past decade, and this is very important for emerging markets and China, because fiscal stimulus tends to be done in a commodity-intensive way. The governments will spend money on building hospitals and roads and railways and harbors. It's not spent on services. So it's very good for commodity producers like South Africa, very good for emerging markets like South Africa and China, and not as good for developed markets. Well, it certainly helps them, that's why it's done, but we get the multiplier effect. So you can see there this very low support over the last decade now, with jumping up to 3.9%. It's a massive stimulus, which is very good for emerging markets and China. Other tailwinds that emerging markets are likely to see include the weaker dollar because of low US interest rates. Emerging markets tend to finance 80% of their external debt in dollars. So low US interest rates and a weak dollar means a lot more liquidity and cheaper liquidity for emerging markets. And the money they need to put down to collateralize their imports are a lot cheaper than before. So it just frees up multiples and multiples of what they can trade. Similarly, as I said, Biden's likely to lead to stronger global trade in 2021 and thereafter due to more collaborative foreign policy. But also it's the result of COVID. If you look at the resilience index of various countries, the developed markets fell 25% as a result of COVID. Emerging markets only fell 10%, and China didn't fall at all. What this means is developed markets used a lot more of their firepower, whether it's monetary policy or fiscal policy, to protect their economies. Emerging markets didn't have as much firepower to begin with, so they used less. The furloughs in South Africa weren't nearly to the same extent as that in the UK because we just can't afford it. And China, because of the way they handled it, they didn't use any firepower. Their resilience is completely unchanged. They've first in and first out of COVID and coming out of it completely unchanged. And that's confirmed when you look at China's Singles Day in November. The Chinese consumer sales numbers were well above 2019. And nearly 4 billion packages were delivered in the first week of November after Singles Day. 4 billion packages. I mean, it's just, the number is mind-boggling. I've been trying to get one package delivered from Takealot over the last 3 days, and I keep missing the delivery. So how you manage 4 billion packages is just something phenomenal. But that is China, and it speaks to the ethos. We have the China 996 work week, where they work 9 a.m. to 9 p.m. 6 days a week. You certainly don't want to live there. You don't want to work there, but maybe it's not a bad place to invest. And China's stock market has been one of the top performing in 2020 as a result of this. And certainly it's helped buoy the emerging market, MSCI emerging market index, well above some other countries. And China announced their 14th five-year plan, as I said, with a 5% growth target, GDP growth per annum over the next 5 years, which is still a significant number on an economy that has a massive base. So all of these points look to a very strong emerging markets, and particularly China in 2021. But generally, there's good news around the board. We've got good news on the vaccine front, which again is better for emerging markets in China. We've got good news coming out of the US with Biden, which again is good for emerging markets in China. And within emerging markets in China, you've got good news coming out of the fiscal support, the resilience, and China's promise to keep growing into the next 5 years. So generally a pretty bullish end to 2020 when looking at the global numbers. And even South Africa, we've managed to end the year on a slightly brighter note. Yes, mixed news. I suppose that's the best we can hope for South Africa, is mixed, not all doom and gloom. But we had South Africa's 3rd annual investment conference. So it is the 3rd year, which means there's of the 5-year plan, there is only 2.5, 3 years to go. But commitments of over 100 billion was a remarkable achievement, according to Cyril. And it keeps South Africa back on track for his 1.2 trillion rand investment target. As I said, 5-year target, and we've got 2.5 to 3 years left of that target. But that's a pretty decent number, and if that all comes into play, that's fantastic. Of course, the devil's in the detail, and if you look at that, I mean, Google promised 2.2 billion rand investment into Cape Town. You look into the details of that, and that basically is a new fiber cable from Portugal down to Cape Town along the west coast of Africa, which is very positive for data within South Africa. But an absolute fraction of the 2.2 billion is going to be spent in Cape Town. Majority of it will be spent laying the cable. So we need to look at these numbers with a bit more detail, but generally a positive story. And the other positive story that I have mentioned before is the trade surplus. So another month. So we're now at 6 months of record trade surplus for South Africa, and in fact the highest in the last decade. And that's been driven primarily through commodities. So we import oil, and oil prices, although they've recovered as one of the COVID losers, we're sitting still in the high $40 a barrel, nowhere near the $100 that we had, which basically halves the cost to import. And exports are looking very strong. Iron ore price keeps rising to new highs. Copper prices strong, all driven by fiscal demand around the world. And platinum and gold are stable and high. So our exports are looking very strong. Our imports are looking low, and that's supporting the rand, as well as the search for yield and the huge amounts of global liquidity that's in the markets. Of course, as I said, South Africa is a mixed bag, and we're still digesting the bad news from the medium-term budget policy statement, where debt's going to peak at 95.3% of GDP. That's a pretty scary number. Increases the chances of a debt trap, and we now have debt service costs of 18% of spending, which is looking quite scary. And the big issue is that even that terrifying number requires this year's wage bill to remain frozen, and the next 3 years to remain frozen, which is a very high execution risk. And as a result of that very high execution risk, Fitch and Moody's both came out and downgraded South Africa 1 notch. For the chart on the right here, you can see we peaked just after the Mbeki administration with our highest credit rating, and steadily throughout the Zuma administration, we got downgraded to junk, and as a result of COVID, that continued in the last year due to legacy issues. So not looking really good. Certainly the lowest credit rating since 1994 in South Africa. And what's more concerning is not only were we downgraded by both Fitch and Moody's, but they maintained a negative outlook. Very, very important. So not only are they saying things are worse, they're saying things are likely to get even worse. So they're not predicting reforms and improvement. They're not even predicting stability. They're predicting that things are going to get even worse from this point, which is pretty concerning. And their main issue is that they don't believe that the government has the political clout to ensure the wage freeze. And I do agree with that view. I think that it's certainly not going to happen that way. If you listen to what the unions are saying, while they want to grow the country, and they're keen to work together and collaborate, we're not going to have a point where wages get to a point where wages are frozen for the next effectively 4 years. Fortunately, there is a lot of talk about social compact, and I do believe that although we'll miss on the expenditure side, we may not get to a wage freeze, but it certainly will be lower than it was in the past. I do think we will surprise on the upside on the revenue side, primarily because of strong global growth. And South Africa is a small, open economy, very much dependent on China, very much dependent on commodities. And when the rest of the world grows strongly in 2021 and the tide rises, South Africa is just going to go up with all the other ships. So when that happens, tax revenues will increase because of commodity revenue, and growth will improve. We also have the investment drive. We have the public-private pension fund program, which hopefully will start next year as well, which will drive growth. And so I think that growth will be stronger than Tito has assumed, and that will balance out the slightly higher expenditure that we're likely to see. So hopefully we will still meet our debt trajectory, and we won't have any further downgrades. But the market's going to wait and see, and that's we're waiting for a stronger catalyst before we actually change our view on being underweight South African equities. So what does this all mean for our investment portfolios? Well, a lot of positives, certainly more positives than negatives. It's been a tough decade. The last decade, we had a very strong dollar, primarily because of risk off. We've had the great financial crisis of 2008. We've had Brexit and Greece threatening to leave the European Union in 2011. We've had the Chinese shadow debt crisis of 2015. We've had Brexit. We've had the trade wars between the US and China, and the US and the rest of the world. And then we had COVID. So just speed bump after speed bump after speed bump. And finally, things are looking a little bit clearer, looking ahead into 2021. We've got the largest fiscal support in 2 decades. That can't be emphasized enough. The largest fiscal support. There's going to be money thrown at commodities and to drive growth. We've also got incredibly strong monetary policy support. Quantitative easing is going to be half of last year, yes, but they're still going to buy $4 trillion of government bonds globally. So we're not even talking about, let alone selling government bonds. We're not even stopping buying. We're just slowing the rate of increase. So there's going to be a huge amount of liquidity as a result of $4 trillion worth of global bonds being bought into 2021. That money's got to go somewhere. It has been going into other bonds or emerging market bonds. But as growth improves, we'll start to see that money trickling into a higher risk or more growth-linked assets, such as equities and property. We've got vaccine deployment, 3 very promising looking vaccines that should start, at least 2 of which are going to start this month. We've got a stable US foreign policy with Biden at the helm, and a stable dollar with low US interest rates. All very positive for global growth next year. Of course, there are risks. We still haven't seen the end of Brexit. We're getting close, but it can keep on being kick down the road, and more likely will be. It's not a train smash. We'll just move the deadline until we get a deal. It means a lot more volatility, but at the same time, it's not a major risk to global growth. The big concern is, and it has been our concern for the last decade, is Japanification, is the low growth, high volatility environment. And the key driver of that is high levels of debt. Because as you can imagine, if you've paid off your house and you've paid off your car and you lose your job, yes, it's not great, but you've got time to breathe. You've got time to look for alternatives. When you owe huge amounts of interest each month and have a massive debt bill and you lose your job, well, then you're forced to do fire sales. You're forced to sell your car. You're forced to sell your house. And when you have those fire sales of assets, it pushes down asset prices, which then just drops confidence, and you end up with this downward spiral of depression and economic activity. So high debt is a concern. And you look at the chart on the right, the horizontal axis shows the increase in government debt to GDP over the last 5 years versus the vertical axis, which is the absolute level. And you can see here Japan at the top, and they went into QE first. 30 years ago, they started fiscal support first, 30 years ago. And as a result, they've got the highest levels of debt to GDP, nearly 300%. We've got Greece next, still trying to get out of the Brexit woes. And then a lot of European Union states, UK, US at 125, the global average just over 100, and you can see South Africa there at about 75. And this all means these high levels of debt means that we are going to see more wobbles. Hopefully not as bad as last year or the last decade, and particularly because we're expecting fiscal support to push us through that, and it should be able to outweigh any wobbles. But 2022, when that fiscal drag starts to kick in, and we're still stuck with these high levels of debt, well, then we may have a less exciting year. But certainly things are looking good for 2021, which is nice to see. And the markets are agreeing with that. 10, 11% up last month, and this month we're only on the 4th of December, and markets are already up 4%. So a nice strong end to 2021, driving up markets. But we think there is more to come. So I was asked for some top picks, and I've got four top picks for 2021, both an overweight and an underweight within each one. So looking at the first top pick, which is our growth assets. What does penicillin, the birth control pill, LSD, and Viagra all have in common? Well, not only have they all been incredibly successful and vital in some cases, pharmaceuticals, they were all discovered by accident. This year, we've had billions and billions of dollars pumped into R&D at the pharmaceutical companies. And not only has that resulted in some phenomenal vaccines in incredibly short time periods, but it's also meant billions of dollars spent in R&D, and we are likely to see something else discovered by accident. So not only do we have very strong vaccine sales likely in 2021, but with all the R&D, we're probably going to have hopefully some great accidental discoveries. But the World Health Organization also put out a report recently saying that we're seeing an acceleration of infectious diseases. Over the last 40 years, we've had an incredible proliferation of infectious diseases: SARS, MERS, Ebola, avian flu, swine flu, Zika, and now COVID-19. And I think that that's going to continue to accelerate. So healthcare has to be a place where as a structural growth asset. You've got massive amount of R&D that have been spent. You've got huge government support. You've got increases in the number of diseases, infectious diseases that are out there. And the reason that we got in a while ago is just the demographic support of aging populations that certainly drives increased spend in healthcare. And how do we balance that? So overweight healthcare, but we are underweight FANG. This is a position that we have continued to be over the last few months. And you can see here this chart on the US, the S&P 500. So the top line that is the top 5 shares from the S&P 500. So that's Apple, Amazon, Facebook, Google, and Microsoft. So those 5 companies have nearly outperformed the rest, the other 495 shares, which is the dark blue bottom line, by 50% year to date. The top 5 shares have outperformed by 50%, quite phenomenal. And as a result, we do think that valuations are stretched in those 5 stocks. We also are worried about numerous catalysts that could overhang those 5 stocks. Antitrust issues, which even under Trump, Google is facing renewed antitrust legislation. We've got privacy concerns, tax concerns, as I mentioned before. Some of these companies have half the tax rate of the S&P 500 on average. And when you've got a twin deficit of 20%, they're an easy target. Valuations is a concern. And maybe the final catalyst is going to be Tesla. Maybe not, but Tesla is certainly leading to a lot of concern and a lot of volatility and a lot of rebalancing that's going to be required to get it into the S&P 500. Still waiting for final details on that. From the S&P, they're going to update us on the 11th of December as to whether it's going to be done in 1 tranche or 2 tranches. But huge volatility for a company that has market cap bigger than the rest of the global car industry combined, producing around 2% of the global cars. It's certainly the valuations are mind-boggling. So that's our first pick is to stick overweight healthcare, underweight FANG. We do still like fourth industrial revolution. It hasn't got the same capped market capitalization weight of the S&P 500. The second bet is now looking on the income space, and here we look at being overweight South African bonds and underweight global bonds. The chart here is very interesting. The horizontal axis gives you term, so that's a cash with a term of 0 effectively, up to 30 years at the very right-hand side, which is your long bond, your 30-year bonds. And then your vertical line gives you the yield or the interest you earn on that. So over the last 30 years on average, which is this light blue shaded area, the last 30 years, cash gave you nearly 10% return with virtually no volatility, no risk of the capital. You could invest 10% in cash, or you could go all the way out to the far end of the yield curve and invest in bonds. And there you're getting maybe 11%, but with huge risk. And the further you come out along this term structure, the more the duration increases and the more the volatility happens to your investment. Yes, if you hold it for 30 years, you'll get your money back. But within those 30 years, you can have huge swings as interest rates go up and interest rates go down. So, over the last 30 years, if you did any sort of quant modeling or optimization, all the models will say avoid South African government bonds. They're a terrible place to be. You're not getting much more return than cash, and there's a lot more risk. But we're now in a very, very different environment in South Africa. And the new phrase is that cash is trash. And cash here, you can see there, giving you just over 3% returns relative to the far end, or even if you go out here to 15-year bonds, where you're getting over 11%. So all of a sudden, it makes more sense to get invested in the term structure, take on some duration risk, and earn 11% with some volatility. That's not a bad risk return payoff compared to 3% with no risk. And so we have switched as much as we can our income and our cash assets into bonds. And we've also funded that by global bonds. We believe that global bonds are a place to avoid. Japanese bonds, 10-year bonds are 0. German 10-year bonds are negative. US 10-year bonds are close to 0, versus South Africa bonds where you can buy them if you're a foreigner, hedge the currency and get 6% in dollar terms. 6 versus 0, it's a no-brainer. And we do think there's a strong risk that as global growth recovers next year, those bond yields will rise. Certainly as the rate at which quantitative easing is happening. So when you see bonds that were being bought at $8 trillion a year last year, it's only $4 trillion this year, and that will lead to less demand, and those yield curves will rise. Not a lot, maybe 20 or 30 basis points. We're not expecting a massive sell-off for global bonds, but certainly a sell-off which will negate the small yield that you are getting and give you at best a zero return. So in the income space, we like global South African bonds at the expense of global bonds, or cash, or local cash. The third pick for 2021 is, and I have mentioned this before, a regional one. So that's being overweight emerging markets at the expense of the US. So the US, we're concerned because of high valuations, pricing in 3 times the growth of South Africa into perpetuity, weak dollar, which translates into weaker returns and rands, and COVID, which the US is still struggling to get under control. At the same time, there's some good tailwinds to emerging markets. We've got $4 trillion of global liquidity being pumped in next year. We've got double the fiscal stimulus that we've seen in the global financial crisis, weak dollar, strong global trade under Biden, and we've got the rise of the Asia emerging market middle class. All will lead to very strong growth in emerging markets this 2021. The other thing to look at is the table on this chart, and certainly there's no history does rhyme, but it doesn't always repeat itself. So this is just looking back. It doesn't guarantee anything, but it is interesting to look back at what's happened to the stock market during various US elections. So the horizontal lines look at all elections, Democrat wins, Republican wins, and the bottom line is most important for us. That's when the Democrats overturn the Republicans, which is what's happened now. We've had Biden push out Trump, and so let's look at this performance on the bottom. And then let's look at the bottom 4 numbers, which is the average since 1988, so over the last 30 years. So this middle one is the S&P 500 over the last 30 years. You can see there that when the Democrats overturn the Republicans in the election quarter, S&P struggles, but over the next year it does okay. So you're looking at -9 to +15, a cumulative return of +5. It's going to go up. So you want to be long equities after a US election. All of these say after US election you want to be long equities. But look at this one here, MSCI emerging markets over the last 30 years. Yes, also struggled up to the election, but in the year, the 4 quarters after an election, 73% return. It's the best block out of all of these. When you have the Democrats overturning the Republicans, you want to be long emerging markets. Well, in the past you did. And we certainly believe that with all the catalysts that I've mentioned, that this will continue. I don't for a moment believe it's going to be a 73% return, but we certainly do think that emerging markets, which have been flat over the last decade, have underperformed the S&P by half over the last decade, and that the tailwinds could lead to earnings growth, and that will allow the market to rise without seeing valuations being too stretched. So that's our third top pick, a regional one, EM versus the US. And the fourth pick is looking for within the value investors. So if you don't want to take a value tilt, then this is long value and short value. However, the chart here looks at the last nearly 40 years and shows the NASDAQ 100 over the Russell 2000. So that's tech versus small cap, and it shows the Russell 1000 growth over the Russell 1000 value. And they're quite correlated. So you can see here tech and growth, obviously tech is a growth asset. So tech and growth being quite correlated. So peaking in Y2K, 1999, 2000, we had growth peaking against value. and we had tech peaking against every other sector. Now, looking at 2020, 2 decades later, driven by a similar concern, tech forced up by COVID at the last into a hyperbolic movement, we had tech and growth outperforming value and the rest of the market. That looks like it's peaked. It has turned, and not sure if it's going to come all the way back like it had in the past, but certainly it looks like the growth story has peaked, and that's very likely, because what drove this last rally was very much COVID-19, and with the rollout of the vaccines, yes, we're not ever going to get back to the new normal. People are going to work from home more, and people are going to travel less. So oil price is not going to be what it used to be, and there's certainly going to be a focus on working from home and manufacturing versus services. And at least for the next 6 months, people are going to be concerned about going to restaurants and the like. But as that unwinds, so this premium is going to unwind as well, and we'll see value recovering slightly. But so we do believe that value will recover, and that we do have an overweight value tilt within our portfolios through our global property. So we are actually overweight global property and underweight South African property, but we have quite a large overweight in global property. We like global property because not only is it a value stock, and it has been hurt through the COVID scenario, but it has structural growth elements to it. You've got cell towers and data storage, all of which are seeing strong demand. Whereas locally, property has got some severe headwinds. Yes, it's looking incredibly cheap. The yields are looking incredibly exciting. But before we even went into COVID, we had firstly the issue with crazy premiums within South Africa due to companies buying their own stock and pyramid structures and all sorts of things with European and Eastern Europe companies that were issuing shares. Then we had a second crisis with too much supply coming online within South Africa, and then we had COVID. So even when you get past the COVID issue in 6 months, you're still going to have a structural oversupply of property in South Africa in the majority of sectors. So we continue to not hold any South African property, and we do like global property quite a lot. So that would be our play as a value play. And those are the top 4 picks for 2021, and we certainly are looking forward to a good year next year. Let me look at Q&A. So the question on the Oxford Astra Zeneca vaccine, one of the things that makes it so phenomenal is that they are going to distribute it at cost until the end of the pandemic. And even then, post the end of the pandemic, they're going to continue to issue at cost to emerging markets forever. There will be some profitability that comes through developed market sales at the end of the pandemic, but that could be a while before that feeds through into that Oxford AstraZeneca. That said, the OSI portfolio has a number of companies all looking at various vaccines, all looking at a number of healthcare issues that can help from detection, from testing, and creating vaccines. So we are very excited about what is happening within the OSI universe. Trump and the 2020 elections, we're not concerned. Most of the lawsuits have already been dismissed or withdrawn. So we do not think that there's a risk of Trump winning the 2020 election or causing any havoc going forward. So certainly there's no chance of him winning, and it looks like he's going to go peacefully out to the White House. Which other international markets do you think are worth considering? We're most excited about emerging markets, but at the same time, Europe and Japan are very geared to global trade. So as global trade comes into play, they will see more of a benefit in the US, and Europe in particular has been pretty hurt by the very high COVID numbers. So they're going to be the biggest beneficiary in the developed markets from the vaccine. So you are going to see the biggest multiplier impact to their growth going forward, and the biggest positive change to growth. So probably emerging markets first, then Europe, then Japan, and then the US from a regional perspective. China looking very strong, but we do like basically all of Asia, ex-Japan from an emerging market perspective, particularly Korea. China and Korea looking fantastic. Those would be our top two bets there. But generally, we like Asia ex-Japan over a Russia or a Brazil. Yeah, so the Health Innovation Fund has struggled. It's been quite interesting to see as the positive news has come out of all of these vaccine companies, pharmaceutical companies. The tech companies have rallied, and our Health Innovation portfolio, or the MSCI Healthcare Index, has actually fallen over the last 2 months. So we have used that opportunity. 2 days ago, we doubled our position in our Health Innovation portfolio, and we did reduce our tech exposure even slightly further. So yeah, we were quite surprised by the performance, and we do think that it is a long-term investment. We think you need a 5-year time horizon for any of these growth assets, whether it's FANG or Fourth Industrial Revolution or Health Innovation. But yeah, we have actually recently doubled that position in our global balanced funds to Health Innovation because of the recent pullback. We don't think there's a change in the story to the outlook. In fact, we think there's an even better outlook story for that sector. So we've used the opportunity to buy. Why is the rand doing so well? Partly because of its starting point. When it got to 19.5, it was so stretched. It was more than 2 standard deviations away from trend, but also partly because the trade surplus is positive. When you have a currency at 15 or even 17 to the dollar, you see the biggest trade surplus in a decade. So certainly the fundamentals are showing that it's still weak. Now at 15, it's looking closer to fair value, but what can push it through fair value and make it stronger than fair value is global liquidity. So a strong emerging market story, strong global liquidity. South Africa will rise with all other emerging markets. We're part of the MSCI Equity Index. We're part of the JP Morgan Emerging Market Currency Index. So we will get bought along with all other emerging markets, and that could push us through our fair value. So while we think fair value is around 15.50, we could see 14.50 in 6 months' time as the risk on global scenario drives all emerging markets. Catalyst for South Africa, that is a tougher one. We are a while away from seeing some concrete numbers on the pension private public partnership, but that is coming through slowly. So I think short-term catalyst, it's either something positive coming out in terms of wage negotiations, so to give foreigners and the rating agencies comfort that there is a political clout to control the wage bill, or positive numbers coming from the revenue side. So that's likely to, and there's always a bit of a lag on those numbers. So that means you're either looking at strong earnings coming through from companies to the end of December, so that's February or March, or the budget speech towards the end of February, or strong tax revenue numbers, which again is towards the end of February, March. So we think that South Africa is certainly going to perform well now, as in line with all the emerging markets. But for us to go overweight, we either going to need, it's probably going to be a couple of months before we see a concrete catalyst, or there might be a valuation gap if South Africa lags other emerging markets sufficiently. We'll be watching both the earnings side and the price side. Yeah, South African bonds, the volatility is a result of interest rates that go up or down. It's hard to quantify the risk, or certainly to explain it to you in person. But generally, what you can look at is a rough rule of thumb. You know, certainly, if you hold a bond to maturity, you get your money back. So there's no capital risk over if you buy a 15-year bond, there's no capital risk over 15 years. The duration of a 15-year bond is roughly half that, say 8 or 9. And on average, although it's not a guarantee, you tend to get your money back in line with that duration period. So if you buy a 15-year bond, the most likely scenario is you have very limited capital risk over that time period, 8 or 9 years. But clearly within that 8 or 9 year period, you can get some big capital swings if there's a massive risk off event and the currency does weaken. So that's why you don't want to move all your cash into bonds. You know, we think a nice split is probably 20% bonds, 80% cash, or 25% bonds, 75% cash. Yeah, Sygnia 4R, we do like it structurally. We do have a small overweight to it, but it wasn't one of my top 4 picks. And we are overweighted and we do like it, but it has run very hard. We think over the next 5 years, it'll continue to do well. It's a great product, and it gives you exposure to phenomenal new technology that is all quickly and rapidly taking market share and will grow even in defensive environments. But not one of our top 4 picks of SA bonds versus global bonds and SA cash, healthcare versus FANG, EM versus the US, and global property versus local property. Once again, on gold, we continue to avoid it. We believe that gold is very linked to global developed market bonds. If you like developed market bonds, you should like gold. We don't like developed market bonds. We don't like gold as a result. They are very highly correlated. They're seen as very similar assets. Yes, there is dispersion from time to time, but we don't think that either of them are giving you the return that's necessary for the risk. And certainly we've seen that play out nicely. Gold at least has come back. It's not looking as stretched as it was, breaking down below $1,800 a barrel. But gold tends to work, as do global bonds, in risk-off environments. And we're not predicting 2021 to be a risk-off environment. Certainly, we think there'll be less risk events. And even where there are risk events, the huge amounts of monetary and fiscal support will help us get through those risk events. So while it's useful to have some gold as or property as a hedge, we don't think you need as big a hedge this year. And we certainly don't have any gold or global bonds. Okay, the toughest question of them all. Looking ahead 10 to 15 years, are you positive regarding South Africa? Do we have a future? South Africa is certainly an emerging market, and I do firmly believe that the next 10 years are going to be good for emerging markets relative to the last 10 years. And as a result, we will rise with China and Asia, ex-Japan, India, Korea, all of those economies moving to new highs and displacing Europe and the US and Japan. So as emerging markets become more mainstream, we will get supported by that. Yes, we have our own issues, and certainly the jury's still out on how quickly we fix those issues. And that's why we are underweight South Africa at the moment relative to emerging markets. But we do like emerging markets, and we do think that South Africa will be, as a small, open, commodity-driven economy, will rise with the tide. We think, I personally believe that it will rise above the tide because we've got coming from such a low base, but there are risks that it will rise slightly below the tide because there's a risk that the reforms don't happen and our debt does not peak at 95%. Another good question on Regulation 28. We still haven't seen any updates from any policy discussion updates on Reg 28. I still don't see the need for any changes. I finally managed to find numbers this week showing that South Africa's investment in private equity currently sits at 2.3% on average for pension funds. That means we can multiply that by 4 before we even hit our peak of 10% in Reg 28. And that's on the equity side. Most of the private infrastructure is going to be on the debt side, which there's no limit in Reg 28. So I still don't understand why we need to change Reg 28 unless what they are going to do is put through some sort of minimum on infrastructure. But even then, ASIS has put out a template on what is classified as infrastructure, and it's the taxonomy of infrastructure, and we're still not sure. I mean, we hold Sanroll bonds, we hold Eskom bonds. Those have to be seen as infrastructure assets. How can they be excluded from infrastructure assets? We hold Mgeni bonds, Mgeni water. How can that be excluded from infrastructure assets? So there's a lot that needs to happen. There's a lot in terms of, first of all, deciding what is infrastructure, and then how much infrastructure should we ideally want. Batsita had a great conference yesterday, only questions, no answers. We're still waiting for the DBSA, who's supposed to be coordinating the whole process with South Africa, and they haven't yet. What we need is one central player to coordinate everything. Ideally for DBSA to create a listed pooled fund where you can get access to all the infrastructure assets, and each project is on a tender basis handed over to a different management company. So the current experts in the field can still get involved, and the big houses can still manage those assets. But as long as it's centralized and pooled, it'll create liquidity, it'll create transparency, and will allow easy access. Right now, there's no transparency and there's no liquidity, and everyone uses those two things. I'm talking about private providers use those two things to protect their turf, which is understandable. Each provider who's been in the space for 10 years has got experience, and they want to leverage that experience. But hopefully the DBSA provides a centralized point which increases transparency, increases liquidity, and allow all funds to access these assets at low cost without huge margins being paid. And then there'll be huge opportunities and huge demand, and will work well. If we don't get there, then if there's no transparency and no liquidity and no centralized position, pension funds, certainly I am not going to want to allocate money into a murky asset. And then we might see the regulators forced to talk about what voluntary prescribed assets, which is one of the issues raised at Batsita, where they say, yes, it's voluntary. You can choose which infrastructure assets you want to invest in, but you must. So we'll see what happens in that space, but it's going to be 6 months before we get see anything in that space. How can you invest in bonds? There is a South Africa Sygnia, 2 Sygnia unit trusts that allow you to invest in South African bonds. One that just tracks the index and one that has some credit, both available on Alchemy. We've got 1 more minute, so I'm going to say thank you very much. Thank you for the questions. Thank you for sticking with us through this incredibly volatile and incredibly stressful year. I'm really happy to see a good positive end to the year. When you get your statements next year, or even your December statement over November, I'm sure everyone's going to be very happy with the returns, absolute returns that we are seeing. And we are likely to see some more positive absolute numbers come through in 2021. And have a great festive season and end of the year. And stay safe. Thank you, everybody.